Hello, everybody. Welcome to Friday, another Talk Money with Tom show. We are trying to help you with your retirement planning needs. We're live here in Silicon Valley, Friday at 12:15, and we really want to be able to answer your questions. Send them in now and see if we can answer them live. You can send them to asktom@talkmoneywithtom.com. You can put them into the chat here on YouTube. We'll try to answer those. You can send those questions in during the week. We get questions from our clients during our strategy sessions, so we always include those also. So really good show lined up today. Please send in some questions and try to participate, and we'll try to have some fun with this today. We really feel that the more you know about retirement planning and asset management and tax planning, the more your retirement can kind of reflect that knowledge and that education base, and you have a better chance of having a much more successful financial retirement. So we put together this channel. You can subscribe to the channel, hit the bell if you want to, get notified when we put new things on here. We're constantly creating new content and what have you too. And of course, we're available on a one-on-one basis to meet with us, phone, video, come into the office, whatever you'd like to do. You can go to the book appointment button on our website. The link to our website is here on the channel, and the button looks just like that. You go in there and you can choose a time that works for you, 30 minutes with Ethan and I, and we can answer your questions on a custom basis. So really looking forward to today. Hopefully everybody gets at least one thing that you can kind of take this week and start to think about and start to implement into your retirement or your future retirement plans as far as that goes. All right. So I do always like to start off the week with a summary of kind of what we saw happen in the week for the S&P 500 and the market as a whole. This is a chart that we've been looking at here for quite some time. This is going back to the very beginning of 2022 for the S&P 500. And you can see that red line there kind of connecting all of those highs on the way down. And then we've had this phenomenal run up. And middle of October is when we hit the low so far. All the way through. Second half of the year last year, market's going to do terrible this year, especially the first half. Earnings are going to be awful. Inflation's going to have a full impact. The impact from the Federal Reserve raising rates is going to have this impact. I mean, this is 9 out of 10 articles, that I'm reading at the end of last year. And even at the very end of last year, the market was selling off. And so it kind of just accelerated those articles. And here we are with this nice run up, and we're going through some very nice, I think, check marks is what I would call these. So one of the things that we look at is what the primary direction is of the market. And what we're really trying to figure out here is when that primary direction is going to change to go to back to up. And I have a checklist that I use for this. So somebody asked me to kind of share that checklist. I'll start with that. I do want to cover our signals and just really quickly kind of talk about that. So the signal right now for our stock market signals is green for both fast and slow signal, and it is on the bond side we're green with yellow on the slow signal. So again, what that means from a signal standpoint is just that the fast relates to our clients' kind of tax deferred accounts, tax-free accounts, IRAs, 401ks, Roth IRAs. And so we tend to make changes a little bit more often because we don't have to account for the taxes in those. We don't have a commission to buy and sell these exchange traded funds that we're using, so that helps. And then the slow is more for these taxable accounts where we don't want as many transactions, really because we're trying not to have as many things end up on the tax return, just kind of a hassle as far as that goes. And so that's what those signals are about as far as that goes. And so again, getting back to kind of where we're at, let's look at what it takes, in my opinion, to reverse direction back to a primary trend. Okay, so first of all, we've got to break that trend line. So the trend line, this is traditional, is across the tops. And so if you look, you can see we had several big run-ups. Yeah? And so we finally broke through that. And then the second arrow there really is just to kind of show that we actually came back down and challenged that trend line again and held it again. That's not on my checklist, that second piece, but still very important, actually. And so, again, breaking the trend line, good, check, got that done. And then the next thing is just getting through the 200-day moving average. This is classic. This is something that's very heavily talked about. Now, I put in 3 smaller arrows there where you can see where it actually made some false moves through the 200-day moving average and then fell back down eventually before the 4th arrow. There's the bigger one. It really broke through, and it's way above the 200-day moving average now. So it's very good. That's really important. The 200-day moving average is on an upward slope. That's another piece of the checklist as far as that goes. So that's excellent. And then there's what's called the golden cross. And so this is when the 50-day moving average, which is that gold line there, crosses up from underneath, up through the 200-day moving average. Again, that's very solidly away from the 200-day moving average. That has a really good track record long term for, when markets continue to move forward. And then what we look for is some higher highs. So I circled the red with red circles, the highs that were all lower than each other. So in other words, we had that very big high at the very beginning of this chart, which was at the beginning of 2022. And then we had a big run up, but it didn't get as high. Another big run up, and it didn't get as high. Third one didn't get it. So that's the connection on the way down. But then this year, so that first green circle there, we had a breakthrough where we had a high that was higher than the last high. And the second green circle there, we just did it again.
Yep.
Yeah, so it's really incredible. Those are very important points of kind of that checklist that you're looking for. Then, as of yesterday, we actually ended up with a 20% run-up on a closed basis up at the end of the day. So if you look back in October, when we hit the lowest point and the close there, to the close yesterday, we end up with a 20% gain. Okay, so officially, a bull market starts with a 20% gain, right? And a bear market basically starts with a 20% loss. So we actually had a 28% loss from high to low in that downturn. So what that means, at least on a technical basis, is that the bear market is over, at least at the moment. So we'll see what happens and see how this plays out. But it is significant, and it can be kind of psychologically, supportive of those people that are trying to get back into the market, because bull markets average about 5 years in length, right? And the average rate of return is 177% during that time frame.
Yep. So you got a long run for that.
That's right. And so, yeah, that's the hope, right? We're looking at trying to reverse direction here. We've got a whole bunch of things on this checklist. There is one more piece that I would like to see that I've had on my checklist really since the beginning, and that is to break through this high we set back last summer. And that high was achieved on August 16th. And intraday, in the middle of the day, we hit a high of 43.25. Today, just before the show started, we had hit 43.22 at some point today. And so that's really critical. That's kind of a really, I think, important last step here. I wouldn't be nervous about this market with all of the things I've already talked about, but I'm really still holding back on some of the more conservative cash investing money that we've been collecting to wait for that breakthrough to happen. Now, one thing we have seen with breakthroughs in this particular market is usually you get a breakthrough, you get this kind of launching effect. It really just takes off and doesn't come back. And if it does, it'll come back and maybe just touch that point again and then go. What we're seeing here oftentimes is it actually breaks back down through that trend before it finally goes up again. So maybe that won't happen this time because we're now in this bull market. We're starting to move forward and things are a little bit different. But it's something I'd be aware of, not too nervous about if we get above and get to 43.50 and then fall back down to 4,300 again or whatever and fall back below. That's okay. I mean, that has been okay at least all the way through this run as far as that goes. So good stuff as far as that goes. So I'm going to switch views here so we can see this a little bit better. But just the other things that are important here. Next week, the Federal Reserve is going to be meeting, and they will announce on Wednesday what they're going to do with interest rates.
Yeah, and that's going to be big for the market.
It really is, and I'll show you why here in just a moment. But what I'm showing you here is the core PCE price index, okay? This is the number, right? Everybody talks about all these different things. What the Federal Reserve, when they talk about lowering to 2%, they're talking about lowering core PCE, not CPI, which is what everybody talks about. And so right now it's at 4.7%. And the troubling thing about it is it's been around there for all year.
Yeah, it hasn't
Really.
really moved.
Yeah, and so it's not coming down as much. However, the market, and I'll show you, this is called the CME Group, and they do a thing on what the Federal Reserve is expected to do at each meeting. So this is showing a little hard to see this, but a 72% probability that they will do nothing. They will keep rates at that 5 to 5.25 range.
Yeah.
Good. So, and that's why it's important. So if they raise rates, the market's not expecting that, right? And so, that would be a problem for the market.
Yeah, there's been a couple of surprises from other countries. I think Canada and Australia
Yeah.
both surprise raise rates.
That's
So,
right. And we saw, kind of it fall off those days too, a bit during those time frames, and mainly because there's some worry that the Fed might be thinking that also. So that's what we'll be watching for next week. Is does this come out to be accurate? So far, this has been pretty accurate. When it gets this skewed, 70+% one way or another, that's pretty interesting. Now, I'm going to briefly jump through the other meetings and the projections. So if you look at the next meeting, which is in July, the 26th of July, the expectation is that we're going to go to 5.25 to 5.5.
Mm-hmm.
Right, so that's a quarter point increase. So do nothing in June, jump up a quarter point in July. If we look at September, it's basically saying it stays at that quarter point increase. So basically doing nothing in September. If we look at the next one, which is November, this is very interesting, moving back down.
Yeah.
So highest probability is 5 to 5.25, which is where we are now. So again, move up in July, stay there, come back down in November, and December is expected to stay where it is now too. So if you look at what the market is projecting right now, it's essentially saying we're going to be staying around where we are right now, more or less, for the rest of the year. That's not a bad environment for the stock market as a whole. I mean, that's doable. Would love to see, some health from the economy continue to come through, and the Fed is able to kind of, see inflation come down.
Yeah.
And so we're going to get back into this conversation. The debt ceiling is now kind of off the table for a while. So we're going to get back in this conversation about inflation versus recession, and you really can't have both. I mean, generally speaking, a recession will knock down price, especially price growth. And so that takes away the, inflation. And that's the fear, is that the Fed's going to overraise rates. And the reason that I think the market is somewhat celebrating the fact that they might pause next week is just because the banking situation is still an unknown. The banks, we're not hearing about them as much anymore, which is excellent. But the credit tightening is a cycle that is definitely going to come into play, where banks start to lend less money, and we end up with a scenario where, they create sort of a slowdown all by themselves.
Yeah, it's like a quasi rate increase without actually doing it.
Yeah, and honestly, that's better for the Fed, because every time they raise their rates, of course, they're paying more on the treasuries, right?
Mm-hmm.
So if the banks, can pull back some and they don't have to raise rates, that's not bad. But the big problem is that they continue to raise rates and the banks pull back at the same time. Those two could create a hard landing, right?
Mm-hmm.
And so that's what kind of we're watching for. So I think they're looking at the right things. Inflation is still kind of hanging in there, so we'll have to see how that plays out. But that's what we'll be talking about. But the market's doing really quite well. It's pretty amazing. So anyway, that's our summary for the week. I'm glad that you were able to join us today, too, to talk about that. And I really look forward to kind of covering this again next week. All right, so what do we have for questions?
So what does the concentration of gains in the big 7 tech companies mean for the stock market?
Yeah, I was at a conference last week, and quite a few different speakers were talking about, the situation with this narrowness in the market. Mm-hmm. And so, especially, for this year as a whole. So we do have a visual on this. This is pretty cool. Let's see here. Oops. And get you in here too, Ethan. There you go. All right, so this is from a Reddit thread. And what this is showing, if you look at that red line, it is the gain in market capitalization for the top 7 companies in size. That's Meta, Google, Microsoft, Tesla, Amazon, and NVIDIA, and Apple. And so, if you look at that, they're up 52% in capitalization.
Yeah.
Right? And the other 493 stocks on the S&P 500 are that light purple line down there at the bottom that's up, I think, less than 1% by the end of the 0.5%.
And you can see how much it dragged up the rest of the S&P 500 essentially.
Yeah, because the S&P 500 is a market cap weighted index, which just means that the bigger the company is, the more impact it has on the pricing of the index. That's not true for the Dow. It's actually price weighted, and there's different types of indexes. There's equal weighted, there's all kinds of things, but most are capitalized weighted, and so the big companies really matter. And yeah, people are putting money into there. That's not surprising, because what's happening is that the market is doing okay, and people are still very much questioning whether it's going to continue to do okay, and so they're looking at quality, right? And so these are companies that have high cash flow for the most part, have high cash positions, have great brand name recognition. And so that quality is something that people are willing to pour money into. Now, generally, the problem with a narrow market is the fact that it is often the sign of a topping market. So it'll get down to a few stocks. We certainly saw that in the 2000 downturn.
Yep.
And then whoosh, it falls apart because of that. And however, this is a little bit different to me. First of all, I think one of the big pushes that happened was the fear of the debt ceiling.
Yeah.
And so that's not a normal scenario. Unfortunately, becoming a little bit more normal, but it's not something that happens all the time. So if I'm worried about the debt ceiling, I may be looking at a Google or Microsoft and Apple, et cetera, as a place to park some money, just because they're sitting on hundreds of billions of dollars of cash. They have a lot of cash flow, low debt. Survivability of a debt default maybe is enhanced in those companies. And so I do think that's part of what really drove this. And if you watch that red line, you can see it really does start to kind of take off the more we got towards, look at what happens here in May. See, this thing just starts going up pretty strongly right there. See that? So that's the debt ceiling money, I think, that's coming in.
Yeah.
Because what we're seeing since the debt ceiling actually is a little bit of spreading out. Some small caps are doing a little bit better. And that's really what we need to see. And so that'll be something to watch. You'd really like to see some of the other stocks that are out there, participating in this run up and such too.
And we did have one of those good days this week. We had the Russell run at 2.5%.
Yeah.
Versus the market, which was barely up that day.
Yeah, exactly. And that's kind of how it works with small caps. They might just have one day a week, unless it really gets rolling, and then they have 5 days a week, like we had, at the end of some of these big run-ups. But yeah, that's enough. That's such an overperformance that all of a sudden you're starting to see, because they're not consistent. And so, yeah, I think there's some hope there. This is a normal process as far as I'm concerned with, the development of the bear market turning into a bull market.
Yeah, and with small cap, it's a very good kind of judge of where the investors feel. Are they willing to take on more risk or not?
Yeah, exactly. That's kind of a mesmerizing visual. It's pretty nice. Whoever did that did a great job. All right, so what's our next question?
What are your thoughts on lump sum investing versus dollar cost averaging?
Yeah, we get asked this quite often. So somebody has some money and they want to know, because you never know, is this the right time to invest, right? I mean, I get that a lot. Is this the best time to invest? And, it's very difficult to tell that. And so maybe one strategy would be that you would take the money and split it up and put it in monthly for a while, just to kind of mitigate some of the risk of putting it all in up front. Well, there's a great study that Vanguard did based on this. And so let me share the screen here so we can see that. And so what they're showing here is just, hey, I put it all in at the front and I'm fully invested for 12 months, my lump sum, right? Versus cost averaging, I'm going to put it in over 3 months. So basically a third, a third, and a third.
Yep.
And now I'm fully invested for 9 months. So first of all, one of the things you notice there right away to me is that you're not fully invested for the full time period. And that can make a difference. The market spends more time going up than down.
Yeah.
And so what that means is if you looked at this over a long enough period of time, cost averaging should do worse, in my opinion, just because during that 3 month time period, you weren't fully invested.
Yeah, you're out of the market.
Yeah, and so, and that's sort of backed up by their study. And I know this is a little bit small and such, but I'll describe. So the first circle says 68%. So 68% of the time, a lump sum investing beats dollar cost averaging.
Mm-hmm.
So this is from what was the time frame on this in total?
I think they went back 1976 to 2022.
Okay, good, 76 to 22. Okay, perfect. So that takes into account a lot of great markets, actually. And so it's lots of ups and downs in there. 68% of the time, better off just putting a lump sum. And then the next two circles are how each one does versus cash. So cost averaging beats cash 69% of the time, and lump sum beats cash 70% of the time.
Mm-hmm.
That makes sense. So over a 12-month period, for the most part, the market makes more money than a money market.
Yep.
On average, not 70% of the time. Is basically is what it's saying. So, all right, but there is one other interesting thing that they put in the study, and what this shows is for each one. And remember that the turquoise blue color is your lump sum, and the gold color is kind of your dollar cost averaging. And what you kind of want to look at there is those tails. Mm-hmm. And what the tails show is kind of how far up or down you got on a 12-month basis. And if you look closely, you can see that the tails are smaller on the gold-colored bars. Mm-hmm. And what that means is there's a little bit less risk to the dollar cost averaging.
Yep.
Even for the 100% equity all the way down. And so if that's the main criteria for risk, then it might make some sense, right, mm-hmm. for the dollar cost averaging. So if that's what it takes to get you to invest, it's better than leaving it in the money market.
Yep.
Right? And so if the dollar cost averaging makes you more comfortable and you really feel uncertain about what's happening, even though it doesn't win as often, it does have a little bit less risk tail there for that downward tail. And you could make an argument for doing that. Whatever it takes in the end to get somebody comfortable, to get them into the marketplace so that they can, make some returns over the long term and hopefully keep up with inflation is important.
So what would you recommend for someone that's like a, kind of like a moderate risk profile with, some loss aversion? Which strategy?
Some loss aversion, I would do the lump sum. Yeah, because to me, you just described almost everybody. Mm-hmm. Right, almost everybody has some loss aversion. So it's more of that somebody with a heavy loss aversion. Mm-hmm. So first of all, be looking towards something more like that 40% equity portfolio instead of the 60 or even lower than that, 20 or what have you. And the dollar cost averaging would not be a bad idea, for that situation also. So, there's that. We run across the spectrum of people's risk tolerance. I mean, mm-hmm. it's really amazing, right? And there's no standard, and that's what's, and age is only a very small factor. I've got very aggressive older people and very conservative younger people. It's much more just so, where you're at in your life, what you've experienced in your life and those type of things. It's your experiences that are coming to play here. So for somebody that had a heavy risk aversion, something, 40% or less stock market exposure on a 3-month dollar cost averaging, I have no problem with that. Mm-hmm. That makes sense. Yeah, nothing wrong with that. All right, what's our next question?
What does exiting a bear market mean, and what happens to the market after exiting?
So, exiting a bear market basically means entering a bull market, mm-hmm. right? I mean, that's essentially what just happened. And so, a bear market is defined by a 20% or more drop, and we did that, and we fell 28% from high to low. As of yesterday, we just went from that low point in October to yesterday's close. We closed 20% higher. Mm-hmm. And what that means is that's the start of a bull market, right? And the end of the bear market. Now, things can happen. Things can fall apart. The world is not a perfect scenario, believe me. But we do have a visual here I can share with you, which I think is kind of interesting. Let's use this shot here. Yeah, there we go. These are the bull markets since 1932, all these, and the bear markets for that matter. Mm-hmm. All of these little blue spikes and what have you. And you can see, the magnitude is kind of amazing. And so what we found in looking up information on this question is that the average bull market lasts for 5 years,
Yep.
has 177% average return during that 5 year period. So that's pretty significant. So what happened yesterday, when theoretically means that we're in for an average of a 5 year run and 177% gain, of which we've made 20 so far. But you can see there's a lot of different ones in there, and not all of them do that well. And it's maybe a little skewed by some of those
Yeah.
really big spikes in there. So it's we'll wait and see. The judgment's out to see what's happening. Because believe me, I'd still say it's 9 out of 10 articles are saying everything's going to fall apart. Still. And I still think, again, I raise my hand, I've been saying this since the very beginning, I think that in a traditional manner, when you look at what's going on with the economy, when they raise interest rates from 0 to 5%, we have a recession, most likely a hard recession.
Yep.
Right? So that's what everybody's looking at. That's what they're looking at. What they're not looking at is the hardest part to look at, which is the effects of the pandemic.
Yeah.
And the pent-up demand and the money that was put out, and even the money it's already been spent. Let's say they're still spending because they want to get out and do things. You lock people up for a few years and people want to live, right? And so we're seeing money being spent in services that's offsetting this concept of this hard landing, at least so far, and it's surprising people.
Yeah, we never really modern stock market never experienced the Roaring 20s, and you can't really judge the market based on that.
Yeah, you can't go back to 1918's dynamics and look at that because it's too far away and too different. Although it did work out sort of like this. There was a high inflationary period. The market did take off. There was pent up demand. There was mask wars. I mean, it's kind of fascinating. Some of it was similar, but what is important here is that it needs to be considered. And too many articles I'm just looking at are basically looking at this as if it's the 70s. You got high inflation, rates go up dramatically, and the inflation gets out of control, and rates go up even more, and the markets suffer, and all those type of things. So anyway, and those are all valid, and those are things that we are likely to be suffering through here. However, there's an offset here with this pent-up demand and this money that's coming out as people continue to go do things. So it's a good question.
This is a question we've been getting a lot lately. How much money should I keep in my emergency fund?
Yeah, this has been coming up a lot, and people are looking for a definitive answer. And so I'll say definitively, there is no definitive answer. That's important to understand, because I've had several situations where people have said to me, well, somebody in my life, whoever that is, has told me I have too much money in cash, too much money in the bank. I need to be investing that. I need to get out there and put that out there. And, how much money should I have in the bank? And so there's rules of thumb, 3 months worth of your, outflow, 12 months worth of your outflow. Yeah. I've never seen that come out in any format whatsoever. It is all emotional. And to me, it's how much money do you need to have in the bank so that when you go to sleep at night and the market is falling apart, you think to yourself, well, I'm glad I got X amount in the bank right now, and I feel comfortable with that. That's it. Because what will happen if you lower that threshold too much for yourself? And again, that could be 5,000 or 500,000. It's a different dollar amount for everybody. But when you lower that amount that you have in your kind of buffer and emergency and mental well-being account too much, you go to bed kind of panicking a bit about what's happening with the market, and that's when you're going to make a mistake.
Yeah.
You're going to move out of the market maybe when you shouldn't, and so having that money there allows you to go through some of the trials and tribulations of the market. I mean, let's face it, the market is a roller coaster.
Yeah.
And we have to be able to find a way to buffer that roller coaster. And the amount of money that you have in the banking system, and obviously you probably want to spread it around and not have more than 250 at one institution, in my opinion, with all the things going on, that kind of stuff. But It's just a matter of what you feel. And this is very strongly opinionated by me because I've dealt with this for years. And when I see people that have run down, whether they invested it or spent it, and they've run down their kind of buffer, they just get really on edge,
Yeah.
right? And so you want to get to that point, and it's not about what you make, because that's what your other money's for. So if I have 200,000 or 300,000 in the banking system and 2 or 3 million invested, you know, now if I only have 2 or 300,000, it's all in the banking system, I might have some troubles, you know, because that's just going to get eaten up. So, you know, you basically don't want everything in the banking system. Although I have seen cases where it's worked. If you have enough money versus your lifestyle, right, you can put it anywhere.
Yeah.
Right. And I met a lady once with $1 million in CDs, but she had a very reasonable lifestyle for that. Plan worked out great.
Yeah, as long as these make more money than she needs,
Right.
she's good to go.
Yeah. And so, but her lifestyle was a lot more narrow than most, in my opinion. But it worked. She was happy, you know, so that's good. For most of us, we need to have that exposure to the stock market, especially, and maybe the real estate market over time too, at least here, to be able to make sure that we can continue our lifestyle the way that we'd like to throughout our retirement, and make sure we have enough buildup of buffer in that to happen. So that happens because you have that emergency cash buffer in place, and it allows you to then invest the rest. Maybe even be a little bit more stock market exposure than you might have. Maybe you go to 60% from 50% or whatever it is, just because you know you have this money sitting there that's going to take care of you at least for some period of time. So again, I don't think there's a hard rule there. It's just kind of when you shut your eyes at night and the market's falling apart, you know, what dollar amount really makes you feel comfortable. If you feel like it's too much, it is. Invest the difference. You know, you're up to 400,000. Used to be at 300. That's a good sign, right? Money's coming in, and so maybe put the other 100 in. You know, so 300 is the number. That feels good with that. So just kind of evaluate that. There's nothing that a financial advisor like me can tell you, or anybody else in your life can tell you either. Now, if you're married, you got to figure that out as a couple.
Yep.
But if it's your mom, your daughter, or whoever it might be that's telling you, and your friend, or oh, you've got too much money in cash, that's what they feel.
Yeah.
That's not what maybe you feel. It's important what you feel. So that's how I would define that. Definitely. It's a great question. It has come up quite a bit just recently.
So this question came in from Steve. Is there any ongoing risk to the growth for having such a concentration of the gains in these 7 stocks?
Yeah, there is. Broader markets are safer markets. When you see breadth, and it goes both ways, but you notice like at the end of 2020, I mean, that what was running started to get narrower and narrower, clean energy and genomics and these different things, which were great, and they're great areas, but it just sort of came from breadth and quality to lower quality and smaller cap, right? We saw that in the 2000 downturn also. So what you really want in a healthy market is that breadth, where you've got this kind of wide market that's moving through with more than just 7 stocks kind of dominating everything. And however, oftentimes in these type of scenarios, you can start off with a narrow base, but that'll be something we're watching for. And again, we saw some of that this week. I feel like the debt ceiling had a big impact on that narrowness. I think that the debt ceiling was part of the reason why people were buying those stocks, personally. And then as soon as the debt ceiling gets signed, and all of a sudden we're starting to see more breadth. We're seeing, like you said, an over 2% return on the Russell 2000, which is a small cap index, this week on one of the days. So we're starting to see, some of the areas that weren't doing quite as well, that were lagging a bit, pick up. It's a very short period of time, but we'll have to watch for that.
Yeah, and you could say that, May had the debt ceiling as kind of that overarching issue, but a lot of these big tech companies had exposure to AI, and then AI kind of took off. And so that was kind of what brought those companies up, but it didn't really bring up the rest of the market with it.
Yeah, exactly right. It really, I mean, it's sort of like the .com arena, who had .com. I remember there was a company, I forgot the name of it, but it was a .com company, and this was during the bubble of the 2000, and they changed their name to include .com, and they went up 36% that day. Same company, same everything, but just acknowledging the fact that they were .com. That's the way it is right now with AI. So everybody's running around. I think that the incidence of mentioning AI in the conference calls, the earnings conference calls, has gone up something like 800%. Everybody's wanting to be, included in that conversation, and what did happen with the .com was really the spread of that into businesses, even like ours. I mean, our business runs unbelievably more efficiently than it did. I mean, I remember it used to take 2 to 3 weeks for 2 people full time to rebalance our portfolios, because it had to be pulled out, put into spreadsheets, and then go back in manually. And as the internet got more and more efficient and bandwidth got better, and the programs that could operate within that got better, we're able to rebalance the portfolios now just in a couple of hours, in one day. So, and one person doing that. These are the types of things that we're going to see probably from AI. All companies can start to benefit. Obviously, there'll be some companies that's like NVIDIA that seems to be sitting on a hot seat and has had phenomenal, returns because of their positioning. I mean, we saw that with Cisco. Remember, I mean, Cisco was the backbone of the internet. So if you're going to have .com, you got to have Cisco. So they were going nuts, and we're seeing some of that here too. However, that eventually spread out to other areas. So I think that's going to work out okay. As far as that goes. But you're right, that AI has been, because really there was a jump in that narrow group with NVIDIA's earnings report.
Yeah.
It really was the catalyst, I think, to a certain degree, to this latest jump in the market as a whole.
So what is a resistance line, and what does it mean to bounce off of it?
Yeah, that was in one of my headlines in my video, that we kind of hit this resistance, and what does that mean? And so I do have a visual for that. Let me share that. We'll use this shot again. Okay, so this is a S&P 500, kind of like what we had before, just a portion of it. And I've got this line drawn there, right where, the top was back in August of last year.
Yeah.
And so what happens, resistance, the idea is that somebody bought at that point, and there was maybe a high level of purchasing that happened to kind of create that peak point, and they lost money, right? They've been waiting for almost a year for that to come back, and now it's come back, and they'll sell to, I got my money back, I'm going to sell. That's resistance. It's resistance to going higher. It happens all over. I could point out all kinds of resistance points on that particular chart. Sometimes it's at these even numbers, because we saw the market get to 42.99, 42.98 for 2 days in a row, because there's a lot of sell orders sometimes at these even numbers.
Yeah.
Or right around those even numbers. And so the highest point we had was 43.25. Today we got to 43.22.
Yeah, it kind of got towards that and just crashed back
down.
Yeah,
that's resistance. That's exactly what's happening. And so the more it hits, the more it'll dry up those sellers, right? It just keeps hitting. If it just falls off, then you're going to end up with something that looks like August there from last year. But it just keeps hitting it. That's a good sign. Dries up those sellers and then continues through. So it's just a battle always between buyers and sellers. So when buyers are moving the market up, all of a sudden they'll hit a spot where there's more sellers, just a group of them. Usually that's around some pricing mechanism and some high point or what have you. Now it can go the other way, because support is the opposite of resistance, where the market has come up and then starts to come back down, but hits a support level where there were a lot of people that bought. And again, it's just the opposite. Oh, I bought it here at 10. It went to 12. It's now back to 10. Man, I made 20% at least temporarily. I think it might go back. I'm going to buy some more if it gets to 10. And so then it tends to bounce upward off of that. So support and resistance are actually quite fascinating to watch and see how that plays out. Nothing's perfect, but
Yeah, and it's usually a zone. I wouldn't say it's
yes.
a lot of people say resistance line, but it's
Yeah.
usually a kind of a zone around that area.
It is a zone, yeah, exactly right. And traditional financial technical analysis, we generally look at a zone around it. Although it is and well, that's why you see, even then, I mean, if the resistance at 4,300, we didn't break that till today. We got right to it. So yeah, there's always some room in there because people put their orders in different places, not always right at the even numbers.
Yeah, and today's close, we're still right below that 4,300.
Are we below it?
It
Okay.
dropped.
Yeah. Yep. Yeah. No, it's going to take, again, I'll make another prediction like I did in my daily videos, but it's going to take a little while for this market to get through this point. And I would not be surprised at all to see us then jump up a little and then come back down and challenge that point, even to the point of maybe falling lower, 4,200 and something again, before we kind of take off. It could be that this is the big jump everybody's waiting for and we take off from here. But there's so many things happening in this market with this higher interest rates and this high inflation. It's a little hard for me to see it really taking off because, again, the big money managers are very traditional in their outlook, in my opinion, and they're looking at this rate increase, and they need to see the Fed kind of going the other way, lowering rates and what have you, I think, to really jump back in. But there is a fear of missing out here that's been driving this market, and eventually that fear of missing out will hit the overall big money managers, and that's how you get those huge returns. I mean, in 1982, after they got inflation down, the S&P 500 went up 106%. That's the big money. That's the money that's sitting on the sidelines. And since October, there's been several surveys of the big money managers, and they have a 70-year low in exposure to the stock market, which just means that there's a lot of money that can come back to the stock market, and that's how you get the 106% returns. It's not you and me and the dollars that we have. It's these hedge funds, it's these big pension funds and whatnot to kind of coming back in. I think they're going to need to see some more evidence on inflation to really get going as far as that goes. So that's why you're seeing it's not a smooth ride by any stretch of imagination, and it probably won't be here for a bit. It's going up, which is good. I like it, but it's probably not going to go straight up. Not for a while. All right, well, that's good. Another great show. Those are some great questions. Really excited that you guys were able to participate today. Please send in your questions at any time during the week here so we can answer them. Again, it's asktom@talkmoneywithtom.com. You can then, of course, subscribe to the channel, hit the bell button if you want to get notified when we put new content on there. We do give you a pretty good signaling system here that you can watch every day. I put out the daily video. We get green, red, and yellow, kind of tell you what we're seeing happening in the markets. We went green back in early May, and we've been green all the way through and riding up this nice run here. We've got some really good pieces that have done well. So those signals have worked out. I really like that process. So that's something maybe worth subscribing for. And then, of course, the last thing, you can book an appointment and just set up a time to meet with Ethan and I, and we'd be happy to meet with you and talk about your specific situation as far as that goes. So looking forward to seeing you again next week. And obviously, I'll have my daily videos on Monday through Thursday, too. See you then. Thank you.